Okay, what is up? And welcome back to another episode of How to Invest in Commercial Real Estate. And we have an awesome show today.
Thanksgiving week.
Yeah, so we're recording this the week before Thanksgiving. So I hope everyone has an amazing Thanksgiving or had an amazing Thanksgiving if you're listening to this. Hopefully we do too.
By the way, I think I preluded this in the last show. Cold plunge is coming up probably next week.
That's right, yeah.
So
we need to hurry up and do this.
No, we want to make sure it's really cold for Braden.
Yeah, good idea. That's right. Next week, cold plunge.
Hey, by the way, nice hats, guys.
Yeah. If you want any merch, hit us up.
Yeah, I mean, it's kind of for investors. So if you
maybe
want any merch, give us some money.
If you want any merch for free, invest.
But yeah, if you're an investor, we're sending a little care package out. So you'll get an email about it. Don't worry. Anyway, we're going to get into the show. If you've been on the investor list or if you've listened to our podcast ever, or basically you know our names, you know we've been doing a ton of retail development deals this past year.
Which isn't our background. We started doing a lot of course, multifamily with Precision Equity, but multi-tenant retail with Criterion, even a little bit of single-tenant retail. But yeah, we've gotten into development. And we get asked, well, why? Why the shift, guys? Why are you doing so many development projects now?
Yeah, so I would say Criterion is a commercial real estate investment company. So like any investment company, we're constantly looking for yield in the asset class that we kind of, brand ourselves on, which is real estate. I mean, it's not difficult. So we're looking for yield in real estate like everyone else, and interest rates are insane. A lot of people are pivoting. A lot of people who aren't pivoting just stopped buying. I mean, there's tons of people who just aren't buying or haven't bought anything in a year. That's not super uncommon right now. So I would say the answer to that question is we're looking for yield because we like raising money, we like placing money in the marketplace, and we think there's a good opportunity right now in this retail development sector. So that's why we're doing it.
Yeah. Well, the interest rates sort of forced our hands, right?
Yeah.
Buying existing asset class, the prices weren't going down, but the interest rates were going up, and so we had to, like you said, we're a real estate investment company, and we had to chase the business where it's at.
Yeah, and I think the important thing here is we talk about it all the time that you're one idea away from a new income stream. You're one contact away from a whole new opportunity, and that's kind of what we ran into with new development. We did a lot of multi-tenant retail. We did a lot of multifamily, and so that new development wasn't really on our radar. In fact, it just felt inherently more risky because of the unknowns, right? We didn't know how it worked. We hadn't done a lot of ground up development. It seemed speculative. And so we didn't really pursue it. But then we got involved as the LP on a few deals and got to know the development game a little bit. And that's helped us pivot in this high interest rate environment to doing more development deals. But today we wanted to talk about, well, how did you get comfortable with them? And why are you doing them? And what's kind of the return metric that you guys are looking at?
Yeah, so I would say you said the answer to the question almost immediately, right? It's we got involved as an LP in somebody else's deals because we realized we're not an expert in this space. We wanted to partner with an expert in the space. And it starts with, hey, you guys seem busy right now. What are you doing? What are you working on? And how can we add any value? How can we help? How can we get involved? And people staying busy in retail development right now still need money, right? And it's
something we preach all the time is we tell people, hey, if you don't quite understand it, partner with us, partner with someone who does. We don't just say that. That's actually how we got started in this.
Yeah, so we had a good value proposition where we are sophisticated real estate investors. We have the ability to bring equity, and we have the ability to bring debt and debt relationships and our balance sheet to the project to help get better debt. So that's a lot of value that can be added to a project, especially from the developer's standpoint or the leasing agent standpoint or the tenant rep standpoint who reps HTO and wants to do, 20 of them a year. He doesn't have, or they don't have, $200,000 or $300,000 or $400,000 per deal for 20 deals. They may be able to do 1 or 2 themselves, or 5 with friends and family, or 10 asking everyone they know. But eventually they've ran out of people. So that's where we can kind of add some value. And then the more joint ventures and partnerships we've done, the more value we've been able to add because we've been learning along the way. We've been asking better questions. We've been looking at sites and doing all of these things to where eventually, we're doing more projects on our own and we're getting a bit more control and a bit more knowledgeable and less risk. I would like to think less risk along the way.
Yep. Maybe we ought to go through kind of step by step, because from the outside looking in, when we were buying existing assets, it's easy enough to say, oh, well, it's kind of like buying a house. You go look at a property. You guys have talked about a lot on the podcast, how you evaluate it. You go and make an offer and you buy it. But land development seems a little more complicated. So I think maybe if we went through it step by step, what is the first step in doing land development? Is it finding a piece of land? Is it getting some tenants who need some land? What do you guys think is the very first few steps?
We're not tenant reps, so we're not actively looking for land for particular tenants.
Correct.
So I would say if you're like us, the key to start is to identify a piece of land in a good location, a good area of town. Things are getting developed, and they've got a sign that says for sale. And you call and they say, okay, that land is $15 a foot, or whatever, $20 a foot, $15 a foot, really good area. And so now what do? Right. And for us, I wouldn't have known what to do before, but now I say, okay, I'm going to tie that land up. I'm going to try to tie that land up for 4 months, 6 months. Then I'm going to go try to find national credit tenants that want to lease on that land, that want to have their locations on that land. So that would be step number one for us.
So when you say you want to tie it up, you make an offer on it to the owner, they accept it, and you put in the contract that you've got 4 months of due diligence or something?
Yep, just like that.
Okay.
Yeah,
and they're willing to give that to you because they know what you have to do, right? We wouldn't normally get 4 months of due diligence on an existing asset.
Correct. Yeah, and you may even get way more than 4 months. You may get 6 months. Mm-hmm. You may get a lot less in a tighter economy where it's more competitive and the sellers are making you perform. But right now, especially when nobody's closing on shit, you can lock it up for a while as long as their ability of their belief of your ability to perform is high. Okay, but I think the big thing with development and the difference between development and an existing building is most people don't they may think they can, but they really don't understand that the commercial real estate investment game has nothing to do with the inherent building, right? And it's that inability of bifurcating what the two things are. Like we know we're buying a piece of real estate, but the value isn't predicated on the piece of real estate. It's predicated on how much money the piece of real estate makes. Mm-hmm. So when you're finding a piece of land, you're quickly running a highest and best use analysis. Like, okay, let's say it's the best piece of land ever and I could get a Starbucks and sell it on a 5 cap and get a $150,000 ground lease or something. What does that get me? How much money is that? Is that $2 million? Is that $2.5, $3 million? And then you say, okay, well, this piece of land is $2 million. Okay, well, that's probably almost out right there.
So before you make the offer on the land, you've got to do all this, right? Because you have to know what that land is worth, what kind of income you can get off the tenants that you can get in there. So you have to make a bunch of assumptions. Don't you have to also sort of lay out in your mind how many tenants you have and what size buildings and that you can put on that land? I mean, you've got to do all this before you make an offer, don't you?
Exactly. That's what I'm talking about, this highest and best use analysis. So, we put together a team of people that can help do this for us. And the first one is just somebody who can lay a site plan out on the piece of land on Google Earth and say, I can fit 15,000 square feet on the site. I can fit 2 pads on the site. I can fit, a 3-tenant retail building and 1 ground lease on the site, and just kind of give you a few options. And then the next phone call is to the leasing agent or whoever you think can get you these tenants and say, hey, if I can get 9,000 square feet, of retail space and a ground lease, do you think you have any interest in that? Or I have this piece of land and the leasing agent may just tell you what the interest is. And then you have to assume kind of a low, medium, and high ground of what you think you could get, again, based on the conversations with the people in the area and the leasing agent and your previous, underlying assumption of why you thought this would be a good place in the first place, and just say, okay, if I could get everything I wanted on this site, what would that be? What would I charge them in rent? And then you have to run an exit value right then, and then you know how much money you can spend.
Yeah, think about it this way. Let's say that I have an acre parcel that I want to put a Chipotle on.
Right.
Okay. And let's say that I think the Chipotle will pay $100,000 a year?
For a ground lease. Sure.
Okay. What about a building?
Yeah. A building, they're probably, $40 or $50 a square foot in rent on
brand new.
Yeah.
So that'd be $160,000. Let's say if it's a 4,000 square foot.
Not too far off. Too far off.
Okay. Let's just take some rough numbers. 4,000 square feet. Brand new build-a-suit in a great part of the market could be $40 a foot. That's $160,000 of rent. What are Chipotle's going for? 5 3/4?
Yeah, 5 3/4, 6. It depends on the market.
Let's just say we're in a good market and it's 5 3/4 cap rate. So I'm dividing the 160,000 by a 5 3/4 cap. That gives me $2,800,000 as an exit value. Okay. Well, let's decide how much is the land. The land could be $18 a foot and it's an acre. So 18 times 43,560, that's $785,000 for the land. Now, all we need to do at this stage, we know we have an exit of 2.8 roughly. This is just rough numbers, guys. 2.8, and we know the land's going to cost us, let's just call it $800,000. So 2.8 and 800,000, we got $2 million to build the building. Now, we don't want to build the building for $2 million because then it's just a break-even exercise for us. Okay, but what if we get the plans from Chipotle and we understand that their building costs $1.5 million. Now we know that there's potentially $500,000 in there. If we get that lease secured, we know that lease is enforceable. That gives us the confidence to close on the land, and we've already gotten bids on their site plan. And so we just, as long as the bids come in about 1.15, we do the deal, and we end up with $400,000 to $500,000 of profit.
Okay, maybe I'm jumping the gun here, but when do you have Chipotle sign a contract that says that they're going to lease that building from you? At what point? Before you
great question.
close on the land?
So, they're kind of like two big practical, umbrella schemes, and then the logistics of getting this done. So once you have it in contract, you're pitching the site, or your tenant. We're not pitching the site to Chipotle. I don't know anybody at Chipotle, right? We hire leasing agents, right? This last Chipotle I did, I think, or we did, I think the shop company helped us. Maybe it was somebody else, but it's always leasing agents, right? So once we get a piece of land under contract, we're getting rough drawings, we're getting site plans, we're getting numbers on how much parking and everything like that, put it in a package, we're blasted out to the marketplace, and the leasing agent is saying, hey, so-and-so is interested, so-and-so is interested, so-and-so is interested. And they're submitting LOIs, letters of intent to lease, just saying, hey, if you could deliver me 3,000 square feet with $50 a square foot and tenant improvement allowance, I'll sign a 10-year lease today with Chipotle credit. And you kind of counter that back and forth until you get to a good number. We're trying to underwrite our unleveraged return on cost, which is just how much we think it will cost total versus how much we think we can get in rent. That's the unleveraged return on cost. So it's really your positive leverage, right? We talk about positive leverage a lot on the show. The positive leverage and the arbitrage here is the difference between what we think the asset will sell for in the marketplace complete with the tenant running. So using the same example, that Chipotle that we think is going to sell for a 5 3/4 cap rate, let's just say it's in DFW, right? So, and we would want our unleveraged return on cost to be 200 to 250 basis points above that number. And that 200 to 250 basis points may change based on the market you're in or whatever other risk you're adjusting, right?
Well, I was going to say, okay, we started with an exit cap of 575 on the Chipotle.
Yeah.
That means we need to build to an 8 for a 2 1/4 spread between the two.
Correct.
Okay, so then it's real easy. Let's go back to our $160,000 number. That's the income, the triple net income that we think we can get out of Chipotle if we build them a building. Well, all I've got to do, instead of putting a 575 cap on that, which gives me a sale price of $2.8 million, I'm going to put an 8 cap on that number.
Yeah.
Right. So I'm just going to divide 160,000 by 0.08, and that's going to tell me what my all-in cost can be, and that's $2 million.
Yeah, so once we get this $2 million number, we've got that signed letter of intent from Chipotle. We take this idea, right, to a contractor, and hopefully it's not the first time you've talked to that contractor, right? Hopefully you've had some if-then conversations with a lot of people before this point. Right. But if you haven't, or even if you have, the conversation goes similarly to this. Hey, I've got a Chipotle. Here's the plans. How much does it cost to build it? Okay. Give me a guaranteed maximum contract for that bid, maybe $2 million or whatever it is.
And you still haven't closed on the land yet.
Still haven't closed on the land yet. Land's still in contract. The lease isn't signed, so you've just got an LOI. So you go get that guaranteed maximum contract and the bid from the contractor. You've got the LOI, and hopefully the LOI is finalized. And at this point, you say, Chipotle, I'm ready for a lease draft, right? You'll turn that lease back and forth with comments 2, 3 times, 4 times. It may take a month. It may take months to get that lease signed. But you really want to get that lease signed. So now you've got a guaranteed maximum contract, which is kind of downside protection for your cost on the unleveraged return on cost. You're working on the lease, which is the only other factor of the unleveraged return on cost, which is your income, right? So you're working on both of those. That pretty much sums up that equation. And then you're just pushing the land on until hopefully the lease is signed. You get the guaranteed maximum contract signed. You've got a lender on board, right? Because you've got the guaranteed maximum contract from the contractor. So we know the building can be built for $2 million. We've got the signed lease from Chipotle. So we know we can get $160,000 in rent. The business plan is done. The lenders agreed. And hopefully at this point, you can finally close on that piece of land.
So let's go back to our example. You got $800,000 in the cost of the land. Let's say the building cost, remember we're dealing with a 4,000 square foot building. Let's say a building costs $250,000. $250 a foot. Okay. And so that is $1 million for the cost of the building. And then we're going to give them, let's call it $50 in tenant improvement dollars, $50 a foot.
Yeah, another couple $100,000.
So that's another couple $100,000. So you got $800,000 for the land. You have $1 million for the base building. That's 1.8. Then you have $200,000 in TI dollars for the tenant for interior upgrades. That's $2 million. And we've already said that if we have $160,000 in rent, which is $40 a foot, that we can get a $2.8 million exit. Yeah. Which is the 8 cap that we wanted, right? Versus the 5.75 that we're selling for. So that 800,000 is the spread that we want to try to make. Now, you say, well, man, that's a lot of profit. Yes, it is, because you have to have a decent amount of profit, because everything that's gonna go wrong could go wrong. You have over budget. You have, of course, you haven't talked about the debt yet.
We haven't talked about the soft costs, the interest carry, the leasing commission, the development fee.
And so there's all those things that are going to eat into that, and we still have to have enough left over to pay the investors a return.
Yeah.
And so that's kind of how this thing goes. But once we have those base numbers done, that gives us the confidence to move ahead.
Yeah. So it's a different form of yield, right? The cash flowing retail shopping centers is a combination of a dividend that's paid out quarterly via cash flow, excess cash flow, just profit month over month. We pay that out every quarter to the investor. Typically that's about 10%. And then the other 10% of the return, what we strive to be another 10% of the return, is a combination of two things: rent growth, forcing appreciation on the property, and then principal reduction by us paying our mortgage every month. So we're underwriting to the exact same yield. We actually end up underwriting better. Again, we're trying to always underwrite to about 20%. Would you guys say 20% is a good number? I mean, give or take a few points.
Try to go north of that.
But these development deals, a lot of them are penciling mid-20s. A lot of them pencil higher than that on the best case scenario. A lot of them are maybe 18 on the low side, worst case scenario. But it's just paid out. Like, the arbitrage is so simple, right? And it's really the cost to build a building. The cost to build a building, the value of a Chipotle lease equals profit. Like, the cost to build a building, or the value of a Chipotle lease
minus the cost
to build a building equals your profit. Like, it's so simple. So as long as you have a great contractor that you can trust to keep you in budget, that's got a guaranteed maximum contract, that is step number one. Step number two, the
national credit leases.
The credit, right?
Two things, guys. First, you got to have the credit in order to have the confidence to move forward.
What is credit?
Credit means they're reliable and that they're not going to default on that lease. You can't go tie up a piece of land and get a local mom and pop,
Joe's Childcare.
Yeah, Joe's jewelry store, whatever, that's selling trinkets. That's not going to be strong enough. And you actually don't know what that's going to sell for in the market. The great thing about the national credit is, if worst case goes, you can't sell it. You know they're going to pay that rent, and that rent's enough to cover your debt service. But two, you should know approximately where that's going to sell at in the market, right? What cap rate on income is that going to sell at? So it gives you confidence to know, okay, if I build this for $2 million and I have some soft costs and I have some developer fee and all that, but if I get 2.8, I'm going to walk away from this thing with some profit. And that's the security that we needed in order to start doing these deals. And now we're in a bunch of them because we're locking up national credit tenants in really good locations, and we're going to be able to exit for a profit for our investors.
Yeah, and if you watch our last show, we've got a bunch of them coming up that are going to sell over the next few months, right?
Yeah, a ton of them. One thing I want to say, when institutional investors are talking about the return, you will hear a term used called discount rate. And discount rate is kind of an epiphany for me when I was learning about this, because we use discount rate or IRR or yield all synonymously, but discount rate is fascinating because when you think about it, you're willing to accept different levels of return based on how much risk you're associating to it, right? So when you see something as super safe, you're like, I can't discount that much. You know, it's super safe. It's always going to be there. It's there every month. Every month I check the first that's in my mailbox. I can't discount that much. There's no risk associated to it. That's Chipotle. That's Starbucks, right? They're going to pay the rent. If they don't, you're going to sue them and win. Very simple. Another form of risk is we buy tons of shopping centers, right? So if you like these tenants maybe have $500,000 to $1 million in sales in a store. They may only have one store. They may have a personal guarantee with like a home and their retirement account guaranteeing it. So you don't have any credit. If the business fails, typically their life is failing. They may be declaring bankruptcy. There's not a lot of recourse for you to go after.
Their life is failing.
Life is over.
A lot of the times it is. If they're not paying the rent and they're one business.
Yeah, no, it's true.
I mean, it's bad. But if you aggregate enough of those, like if you can get 50 or 70 or 100,000 square feet of those, credit profile tenants, and then you have the leases rolling, over a period of time or a long period of time, you can kind of discount that to around an 8 cap. And that's what we're typically buying. But because we're getting such better credit, Salad and Go, Seven Brew, Chipotle, Starbucks, learning experience. There's amazing credit we're going after and developing for right now. The buyer, right, that we're selling it to is discounting it way less.
Right. Yep.
Yeah, so I think the point of the show, and we're going to wrap it up, is that we were doing shopping centers, we were doing multifamily, and because we were willing to take a risk and be an investor on retail development, we're starting to learn that game, and now we're able to offer those opportunities to our investors. And what we found is that, like everything, it's not that complicated and it's not that difficult once you get in and you understand it. The only reason it seems risky to an outsider is because they're lacking the knowledge and experience that others have. Mm-hmm. And we were lacking that knowledge and experience. But once we started to partner with those that did have it, then we began to see how the process goes. And so we always want to encourage you guys to dive in. Even things seem risky, they seem complicated. It really isn't that difficult. Once you learn it, it's like, oh, wow, this is simple. To do a development, all I need to do is tie up a piece of land, and then I need to find a leasing agent that wants to bring Chipotle into the market, and I'm going to back of the napkin figure this thing out, and then I'm going to, if you need equity, you're going to call us. If you need a loan, we're going to maybe suggest a lender for you. But anyway, that's just, we want you to realize that that's how every part of real estate goes. And we haven't done office warehouses yet, but we've looked at it, and there's going to be a time where we've done those, and we're developing new apartments. That's new for us. Each time you do something new, it's uncomfortable, and you're going to feel that it's risky. But once you gather the experience, it's going to become second nature to you, and then you move on to the next thing.
Yep.
I was just thinking that this is probably the exact same thing that guy said when he built the submarine and took everyone to the bottom of the ocean. Like, this is so easy. We just get a PlayStation remote and some metal.
We put some steel together and
weld it in there.
And then we go crush our souls at the bottom of the ocean. All right, guys. We want you guys to know we've answered the question, why are you guys getting into so many new development deals? Hopefully you got that, and hopefully we keep rolling them out for you in the next new year.
All right. Well,
thank you.
Hope everyone had an amazing Thanksgiving, and we will catch you next week on how to invest in commercial real estate.
Thanks, guys.